Most people don't struggle with money because of math. They struggle because they don't have a plan. And building a plan can feel intimidating. There's too much information, too many strategies, and it's hard to know what actually matters. That's why I made this video. I'm going to give you a step-by-step 90-day plan to reset your finances from the ground up. By the end, you'll have a working system for building wealth and a real head start on your financial life. We'll cover investing, how to allocate every paycheck, and how to cut the biggest expenses you carry. Let's get into it. 90 days breaks down into roughly 12 and a half weeks, so I've structured this plan week by week, one clear objective at a time. Week 1 is about getting brutally honest with where you stand right now. Before you fix anything, you need to know exactly where your money is going and exactly how much is coming in. Every successful business tracks two numbers without exception: revenue and expenses. Walk into any well-run company and they can tell you their daily profit and loss down to the dollar. This week, your job is to run your personal finances the same way a profitable business runs its books. Here's the exact move. Pull your bank and credit card statements for the last 3 months and open every one of them. Checking accounts, credit cards, any recurring debt payments. Get it all visible in one place. Then sort every transaction into 3 buckets. Bucket 1. Bucket 1. Fixed costs, rent, utilities, car payments, subscriptions, groceries. Bucket 2. Discretionary spending, dining out, travel, shopping, anything that's a want rather than a need. Bucket 3. Debt payments, student loans, credit card balances. Log every transaction in a spreadsheet so you can see category by category exactly where you're overspending and where you might have room. By the end of week 1, you want your average monthly spend in each category plus your total income. Subtract one from the other, and you have your savings rate, your net profit margin, in business terms. This single exercise is usually the moment people's eyes open to their own habits. You'll likely find money leaking into places you didn't notice: rideshare apps, a forgotten subscription, restaurant spending that's crept up. Finish this audit, and you're set up for week 2, which is where we start cutting. Week 2 is about trimming the fat, finding the fastest, easiest wins first. Take your expense list and rank it from largest to smallest. Say your monthly spending looks like this: $4,065 total across rent, car insurance, groceries, dining out, shopping, rideshare, utilities, subscriptions, bars, and coffee. For each category, ask one question: can I cut this by 10 to 30% over the next 90 days? For this example, that means finding roughly $400 to $1,200 a month in savings. Start with rent, usually the hardest to move, since it's your largest line item, and moving isn't realistic for most people in the short term. You can try negotiating with your landlord, but in practice, most people won't, and that's fine. Now look at the easier targets. $225 a month on rideshare apps. Ask yourself why. Is it convenience? Laziness on a weekend night? Once you spot the habit driving the spend, cutting it in half or eliminating it is usually simple. Walk, take transit, and you've freed up over $200 a month. Car payment and insurance at $750 a month is another target. Most people never shop competing insurance quotes, and doing so can easily save another $100 a month. Shopping and dining out are next. Even a modest cut of $50 to $100 in each adds up to another $100 to $200 a month. Cancel every subscription you're not actively using. Work through your full list and ask, honestly, is this spend actually necessary? When the answer is no, cut it. A $400 monthly reduction adds up to $4,800 a year, money that can fund an investment contribution, accelerate debt payoff, or simply build real security. Weeks 1 and 2 are entirely about cutting waste and understanding your spending with total clarity. Week 3 is automation, the pay yourself first principle. Open a high-yield savings account for short to medium-term savings and check for a competitive rate. At the time of recording, top accounts are paying around 3.84%. That's the right home for money you'll need within 1 to 5 years. $10,000 sitting at 4% earns roughly $400 a year in free interest for 5 to 10 minutes of setup work. Next, Set up automatic transfers so that every time you get paid, a fixed percentage moves out before you ever see it. This single move, automating your finances, is one of the highest leverage things you'll do this year because it removes willpower from the equation entirely. Here's exactly how I run mine. I'm paid once a month on the 21st. That paycheck lands in checking, where my fixed bills and everyday spending are drawn from. But before I can touch it, 2 automatic transfers fire, moving a set percentage into savings and into my investment account. Aim for at least 10% split evenly, 5 into savings, 5 into investing. Do that consistently and you're already ahead of most people. Psychologically, it works because the money is gone before it registers as spendable. The same logic behind a 401k contribution. You never see it, so you never miss it. Week 4. Build a payoff plan for consumer debt. If you're carrying a high-interest balance, credit cards especially, find the exact number and build a plan to eliminate it fast. Search for a credit card payoff calculator, enter your balance and monthly payment, and see what an extra $50, $75, or $100 a month does to your timeline. On a $2,500 balance, an extra $75 a month can cut 8 months off your payoff schedule and save real money in interest. Set that extra payment to autopay so it happens without you thinking about it. Also, call your card issuer and ask for a lower rate, even temporarily. Mention competing offers and your payment history. Worst case, they say no. Best case, they cut your rate to keep you as a customer, and that can save hundreds or thousands in interest. The average credit card APR today is over 21%. Paying that down is the single best guaranteed return you can get. Week 5. Build your emergency fund to $1,000. That number matters. It's the point where your account crosses into 4 figures, which is a real psychological win. 59% of Americans can't cover a $1,000 emergency today, so this is a meaningful milestone, not a small one. If you're already past that, your goal shifts to 3 to 6 months of expenses, or at minimum, a written plan to get there. Sell items you don't need, pick up short-term work, or redirect the savings you freed up in weeks 1 and 2 straight into this fund. And keep it in a high-yield account. Wealthfront, SoFi, and Ally are common choices, so it earns while it sits. Week 6. Set up your investments. This is the step that actually builds long-term financial independence. Historically, equities have outperformed nearly every other major asset class over the past century, outpacing bonds, real estate, gold, and collectibles by a wide margin over long time horizons. Every high net worth individual I've studied agrees on one principle. Wealth is built by concentrating capital in growth assets over time, not by avoiding risk entirely. So this week, start putting money into the S&P 500 through low-cost index funds or ETFs. A single S&P 500 ETF gives you exposure to hundreds of leading American companies in one purchase. It's a passive buy-and-hold strategy built on the market's long-run historical average return of roughly 8 to 10% a year. Open a brokerage account. Vanguard, Fidelity, Schwab, and M1 Finance are all solid options. And route part of your automated savings there every month. Run the numbers. Investing $1,000 a month for 30 years at an 8% average return puts you at roughly $1.49 million. The plan only works if you stick to it. Consistency, not timing, is what compounds. Week 7. Focus on increasing income, not just cutting costs. We've spent 6 weeks trimming spending and automating what you already earn. Now we grow the top line. Option 1. Ask for a raise, especially if you haven't had one in over a year. If it's been more than 2 years, that conversation is overdue. Inflation has been quietly eroding your purchasing power the entire time. Research market rates for your role before you ask, and build your case around data. Even if the answer is no, you've tested the market and confirmed you're being paid fairly, or found out you're not. Changing jobs every 2 years has historically driven meaningfully larger salary jumps than staying in place, often 30 to 40% higher, depending on your field. That's not universal, but where it applies, it's one of the fastest levers available. Option 2, pick up supplemental income. Freelancing, reselling on local marketplaces, driving, pet sitting, delivery work. Option 3, build a high-income skill. Coding, video editing, sales, design. That raises your ceiling permanently, rather than just this month. There's a hard limit to how much you can cut. There's no limit to how much you can earn. By the end of this week, commit to one specific income lever and act on it. Week 8. Write down a savings target for the rest of the year. We've already covered several goals: emergency fund, investment account, debt payoff, but you may have others: a house down payment, a wedding, a business launch. Whatever it is, write the number down along with the amount required to hit it. Example: if your emergency fund target is $8,000 and you're currently at $1,000, you need $7,000 more over the year. Roughly $583 a month. That's not always easy, but the act of writing the goal down alone increases your odds of hitting it by roughly 42%, according to research from a psychology professor studying goal setting. People who wrote their goals down, built a plan, and shared it with someone else were significantly more likely to follow through than those who only thought about it. So write it down and tell someone: a parent, a friend, whoever holds you accountable. Week 9 is about credit cards, a genuinely double-edged tool that requires real self-knowledge to use well. If you have strong spending discipline, the ideal setup is running every purchase through a card and paying the full balance every single month. Do that consistently, and you're rewarded with cashback, points, upgrades, and lounge access, effectively free money from the banks, funded by the interest paid by less disciplined cardholders. If discipline isn't there yet, credit cards get expensive fast. Carry a balance, and the average rate is over 21%. The average American currently carries a balance of $7,236. That's an expensive habit. If you're unsure where you stand, test yourself. Get a card with a low limit and run it for 3 to 6 months to see how you actually behave before scaling up. Used responsibly, credit cards also build your credit history. On-time payments make up 35% of your credit score, the single largest factor. Consistent, full monthly payoffs signal reliability to lenders. Over time, that translates into better rates, higher limits, and access to larger financial tools. Mortgages, business credit, potentially saving you thousands of dollars over your lifetime through a stronger credit profile. Week 10, start tracking your net worth. This is genuinely satisfying to watch over time, especially as your income grows. The calculation is simple. Add up everything you own, subtract everything you owe. Example: a home worth $100,000, $25,000 in investments and cash, minus a $30,000 car loan. Net worth $95,000. I track mine monthly, though quarterly or twice a year works just as well. The point is a consistent long-run view of how your financial picture is actually moving. Track it consistently, and in most cases, it moves up. Week 11, go back and re-audit everything you tracked from week 2 through week 10. 8 weeks have passed since your original spending analysis, and it's worth checking whether you're still on track or whether small leaks have crept back in. Spend an hour, revisit the last 2 months of spending, sort it into the same categories, and compare it against your original baseline. Ideally, nothing has crept up, and ideally, the categories you targeted have actually come down. Fix any leaks before week 12. Then, in your final week, set 3 targets: 1 year, 5 years, 10 years. A 1-year goal might be $10,000 saved. A 5-year goal is bigger: a property purchase, a business launch, or a specific net worth milestone. A 10-year goal might be financial independence or early retirement. Once you have the numbers, break each one into concrete monthly actions. If a home purchase is 5 years out, calculate exactly how much you need to save each month to fund the down payment. Finally, put a recurring quarterly check-in on your calendar. A fixed date every 3 months to review progress, so 90 days of disciplined work doesn't quietly unravel. This reset isn't easy, but if you follow it, you finish these 90 days in control of your money, and that's just the starting point. Wealth isn't built overnight. It's built through consistency, discipline, and a long-term view.